to have you here for our lunchtime event today, entitled Outlook for the Local Economy. And we're really pleased to have this discussion, which will be recorded and offered on our press club site and other outlets afterward. So, we'll encourage everybody to share this too. But we're so thrilled to welcome William, goes by Bill Adams, a senior economist from the PNC Financial Services Group, and then Dr. Kay Strong, a professor at Baldwin Wallace University. This is moderated by Elizabeth McIntyre, executive editor of Crain's Cleveland Business. Thank you again for joining us, and we'll get underway. Elizabeth?
Thanks so much, Denise. It's so nice to have everyone here with us today. I think this is going to be a lively conversation as we geek out a bit on some economic news and other stuff that's going on. And really, when you think about what we've been through in the last year, the economy is at the core of everything. Our recovery, everything we've been through. So the better understanding we have about the issues that are affecting us nationally, but also regionally, is very important to not only how we run our business, but also how we live our lives, since we are an economy that's based on consumer spending. So everything we do impacts the larger scope, the larger issue for the United States and globally. So we've got a lot to discuss. We've had some news today that we'll be discussing as well. So why don't we just go ahead and get started? Kay and Bill, it's a pleasure to be speaking to you, especially with your wealth of knowledge about economics. So as we all know, we had a tremendous amount of economic uncertainty because of COVID. And the rollout of vaccines and a third round of fiscal stimulus here in the US have given many of us hope. Biden yesterday set an optimistic tone during his congressional address that the best was yet to come. Now, earlier today, we get the news that the US economic recovery really picked up speed earlier this year, with the economy growing 1.6% in the first 3 months of the year. In fact, it appears likely, according to the Bureau of Economic Analysis, that all coronavirus era losses will be recovered by the middle of this year. What are your takeaways from today's economic news?
Should I give you the good news or the bad news first?
Let's go with the good news, if you don't mind, Kay.
For sure. So the good news is that any positive growth rate is a plus because it suggests that we're moving forward. Over the past year, there's been substantial losses, obviously, in real GDP. Output is down in most sectors. So this positive growth, it'll get us moving in the right direction. So over the next few months, we should expect past the first quarter into the second, that the second quarter numbers should be higher than the first, and hopefully third and fourth also.
Do I have to do the bad news now? So I think the bad news is that while it's very heartening to see the recovery accelerating, we still have quite a ways to go. As I'm sure you're all aware, that this economic downturn has hit people on the lower income jobs harder, people who have less household wealth, less savings, people working in the leisure and hospitality sectors, and has also been an especially difficult downturn for women who are disproportionately pulled out of the labor market by childcare and other caregiving responsibilities. And so what the economic data out this morning, it's great to see the economy moving in the right direction, but we're at a kind of a strange point where there is a lot of stimulus. There's a lot of spending power in the American consumer sector right now. But until we can kind of get the in-person schooling and other kind of more high contact parts of our society back functioning again, it's going to be hard to get the labor force participation back and to have that a broader based economic recovery. We're headed in the right direction, and I think I look at the vaccination and case numbers for Ohio at least as much as I look at the economic data. I live outside Toledo myself, so not Cleveland, sorry, but nearby. And I think that is I think the number one. If you want one number to look at for where is our economy going to be in a month or 2 or 3 months, for me, the go-to number is the vaccination number for Ohio.
But what does it mean if, we kind of seem to be stalling out now with that vaccination number in the state of Ohio? I mean, we're kind of stuck around 42%. What if we get to 50% and it stops? And I know you're not a doctor. I'm talking about,
yeah,
the economic aspect.
Please.
I was just going to say that even from the very beginning, the Federal Reserve and the CDC have been on target with the interplay between the two, that the health of the economy is premised on the health of the population. So if we're really expecting to move the numbers forward in terms of incomes and jobs and whatnot, it really is a function of health. So that message really has to become something that becomes an everyday conversation for the guy on the street, for the woman on the street, because again, whatever happens to them is going to happen for the economy. So the two are inextricably linked together.
Bill, is there anything you would add to that?
I think I feel like we are, I remember very early in the pandemic, or maybe even before the pandemic started, I was taking my daughter to a doctor's appointment, and they had a taped to the glass where at check-in a notice about a measles outbreak in Michigan, which is just across the state line from me. And I think there is a strong possibility that we could end up transitioning from a situation where we're in a pandemic to one where we have endemic coronavirus, where it's just something that people are going to have to learn to live with, and we're going to have to develop new societal norms about when do you wear a face mask and what situations are acceptable risk for people in different categories of vaccination or non-vaccination, or children not eligible to be vaccinated now. My kids are under 16, so I think that we're most likely we're headed into a messy period where in many respects the economy is reopening. A lot of high contact businesses are reopened. Restaurants are seating people indoors again, and we kind of need to. I don't really know how it's going to play out with that happening at the same time that the coronavirus is sticking around with us. But it does look like that is going to probably continue to be an issue at least over the next couple of months. But I think I reinforce Dr. Strong's comment that the more we can do on vaccination, the better the economic prospects are.
So with the expectation that the US and other advanced economies like in Europe are going to rebound at some point in this year, what about the emerging markets and developing countries where the vaccine rollout has been slow to non-existent? There's a risk of a diverging recovery path globally. What impact could that have on us here in the United States?
So I think the way I think about this is there's kind of a global vaccine output and there's global vaccination uptake right now. And vaccination uptake in the last couple of months has been really concentrated in the UK and the United States, because both the UK and the United States have large domestic production, and we have restrictions on exports of vaccination in both of those places. And I think as the news that we have locally in Ohio about vaccination uptake starting to slow, it's a challenge for our community, But what it also means is that there's going to be more supply globally, and the vaccine supplies outside the United States are going to increase quite rapidly as a result. So I think what I would expect for places like China is sort of a special case since they've done much better at controlling the pandemic all along. But outside of other emerging markets outside of China, it looks like we're going to see vaccination probably start to really pick up during the second half of this year, in the year end, and into early 2022. I think there's still reasons to believe that production will accelerate, as that production will accelerate at the same time that demand will probably be falling, first in the United States and then in Europe, and so that will, I think that will allow emerging markets to recover faster as that goes through. Obviously the cost in human lives of that delay is very significant. Looking at the sad news out of India in the last few weeks, but I think in terms of what it means for the economy or for demand for capital equipment manufactured in Northeast Ohio, I think it means that we're going to see emerging markets recovering, and their participation in the global economy will also recover in 2022, and not that far behind the advanced economies.
Right. There's a secondary implication we also want to pay attention to. We purchase a good deal of resources and intermediate component parts from other countries around the world. And if those economies aren't fully functioning and that output isn't coming off the lines, that means that it also handicaps and slows down the production in those areas. And I think that the semiconductor chip market is one of those primary ones. We've heard that Ford and other manufacturers, and now some of the computer companies, are having difficulties, obviously, getting those semiconductor chips, which means that they have lost revenue and they'll have lost profits as we pass through the year. I think Ford is projecting a $2.5 million after-tax loss in profits, and Apple, I think, was projecting between $3 and $4 million loss in revenue due to these kinds of blockages in the supply chain as we move forward. And they won't be the only ones.
So let's talk a little bit more about the supply chain. I mean, we've seen a tremendous disruption in the supply chain over the course of the last year, and of course all the ripple effects that has, and then compounding it is what happened with the canal blockage earlier in March, which delayed things for almost a 2-week span. So when do you see the supply chain getting back to normal, or has these disruptions really changed the way businesses are going to operate their supply chains and where they're going to be looking for goods?
Go ahead, Bill.
Okay. My read on this is that there are a couple of moving pieces. One is that the pandemic just continues to interfere with the normal functioning of many businesses and of the labor market, and so that is delaying the normal functioning of the logistics industry. And so I think in advanced economies, we're going to see that recovery improving, I would expect, over the next couple of months. Looking at global supply chains, I think that is going to be an issue that lingers into the end of this year and potentially into next year. A separate issue is that businesses manage inventories, try to manage inventory levels in anticipation of what their near-term sales are going to be. And the global economy is, accelerating all around right now, really exciting and heartening news. And so every business is trying to add to inventories at the same time. So there's a lot of extra demand on the good side of the economy as the retailers and their wholesalers try to build inventories, and manufacturers try to have inventories of components to anticipate their future demand. And so that those inventory builds tend to kind of overshoot what demand eventually is. And I would expect, not this quarter, probably not even the second half of this year, but next year, we could see a situation where all of a sudden businesses realize they have more inventory that they need, and we could see a pretty sharp slowdown in demand on the manufacturing side of the economy. In particular, as the pandemic kind of comes under control, consumers can spend more on services, and that drives a recovery of the parts of the economy that are less goods intensive.
Yeah, Bill's a lot more optimistic than perhaps I am. I don't see anything happening sometime between 2 and 3 years out for things to smooth out. There are really, really lots of moving parts in an economy. And while we look at the big picture and we say, well, we've got these jobs, we got this jobs over here, and we have goods over here, we have firms over here, all of those things have interlinkages. And when it's like throwing a penny into them, and then everything locks up. And it takes a while for things to start spinning in the right motion in order to bring larger and larger component parts back into a functioning for the economy.
Do you think that some companies might say, hey, I'm no longer going to be looking at my supply chain for the cheapest place that I can get it, and instead want the stability of having it closer to home? Do you see that kind of a disruption?
You're looking at manufacturing, and it's pretty broad. I think it's probably a function of how intensive the infrastructure is for a particular business. A reason that a lot of businesses, we don't have a lot of we don't have the semiconductor industry in the US. Part of this has to do with the fact that it can be done with less expense overseas. And that doesn't necessarily just mean labor costs are less. It could be the resources, the companies that are producing are closer to the resource base. But if I'm a company and I need to produce something, I will go for whatever it costs if I'm going to put it out there, and then hope that the pass through for consumers is there so that consumers will ultimately pick up the higher price, assuming that they want it. And as long as demand is high or strong, that pass through is a go-to for a manufacturer.
Let's talk a little bit about jobs. So during the pandemic last spring, we lost 22 million jobs roughly. Since then, about 2/3, again, roughly, have come back, but we're still missing about 9 million jobs. So when do you see those jobs returning? Do you see those jobs returning, or is job growth going to remain sluggish?
I would suggest that the jobs that are available or those that can be brought back online will be available with, as we pass through this year. But I think the more important issue is what's happened to the permanent job losses. There are between 4 and 6 million jobs that will never return to this economy. And they won't return to this economy because, as the Wall Street Journal posted out earlier this month, there are 200,000 closures that occurred last year. And when those businesses leave, the people who work there are left without. And then they have to scramble with everybody else for whatever remains in the local job market. There are major companies that have chosen to go or have gone under. There are some major companies that have left local areas, for example, Cleveland, but still remain open elsewhere. But there's also a lot of small businesses, what you might consider like mom and pops, that also have closed. And that means that where they employ 2, 3, 4, or 5 workers, those workers are also out. So I think there is this huge hole that will only be refilled through major expansions or the creation of new job opportunities in new industries.
I would just, I think that's correct. I would just add on the local angle, one aspect in which this downturn, many ways this downturn is totally unlike past downturns, but thinking for Cleveland and for Ohio generally, like this was not a manufacturing downturn. The manufacturing industry is actually bouncing back quite a bit faster than other parts of the economy. Think services in downtown in Manhattan or downtown Chicago. The manufacturing industry is going to bounce back faster. and that will be and so that's a positive for our region's economy. We're also, this has been a downturn where demand for housing and demand for people to shift into less dense areas and less dense living environments has kind of pulled people out of the largest cities in the United States and the downtowns there. So I think that the upside possibility for our region in this downturn is that, this is not like 2001 where China joined the World Trade Organization and we shed manufacturing jobs by the millions. This is not like 2008, 2009 where we had this collapse in demand for autos and for consumer goods. This is going to be a downturn that Ohio, our industries can do quite well. The risk is that we could see another wave of retirements and people moving out of state because of that, and people do tend to retire more during around recessions. So I think that as a driver of population loss and labor market loss is a risk right now.
Do you think that certain sectors nationally and locally were more hard hit than others and have the potential not to bounce back as quickly?
Yeah, the leisure and hospitality industries are the ones that were the hardest hit, and other kinds of services like professional services and whatnot. Again, those some of those lower end personal kinds of services are also the services in which the companies have gone out of business. So their coming back would imply the ability to potentially start over someplace else. But that was a significant loss for Ohio and for the U.S. in general.
Another, I would say, is brick and mortar retailers, because we've seen such a shift to e-commerce in the last year. That's going to mean less demand permanently for a lot of brick and mortar retail, and also the possibility that we could see a permanent increase in work from home and reduced demand for office space. I think there's big uncertainties about what's going to happen for demand for office space and kind of the economies of urban cores in major cities over the next couple of years.
But that loss in commercial real estate is not necessarily a potential major loss if commercial industry or commercial real estate can figure out a way to flip it for other uses. I mean, there are lots of other uses for building spaces. And if I think about Cleveland and some of the Lakewood area, rents are just becoming a burden for people who have to acquire housing through rent. Paying $1,000 out every month is a huge chunk of cash. It can be 40, 50, or 60% of any worker's salary. And so the ability to drive increases in potential residential units would be a real plus for anybody in the Cleveland area.
For our audience today, if you have any questions you'd like to ask, please use the chat function on the bottom of your screen, and I will get to them as those come in. So Team NEO earlier last week released its quarterly economic report for our region, and it found that nearly every sector in Northeast Ohio's economy is projected to grow this year and faster than previously expected. What is your sense for this year?
Go ahead, Bill.
I mean, in terms of growth rates, we're going to see awesome numbers this year. It's going to be, very, very strong percentage changes. But a lot of this, it's what will show up as growth is really just recovering activity that has been kind of, delayed or on pause because of the pandemic. There's still, Elizabeth, as you said, there's still this big pool of people who've been displaced from the job market, aren't working, and could come back to jobs if they were to become available again, and if all of the other ifs of life were sorted out. And then there's after that we're looking at what is incremental growth of the economy. I think the areas where I think you can say, very definitively where we're seeing very strong incremental growth right now. I mean, number one's the residential real estate sector, where we've seen really rapid recovery of employment, of activity, of housing sales, housing starts. And that's one that we think where we're expecting that to continue to be a driver through the rest of this year.
Right. And I would add that while we're going to see increases in output, we'll see increases in people becoming employed, it's not going to be a balanced recovery. There are going to be people who are still shunted to the side. There are going to be businesses which are going to have difficulty getting any traction at all. So again, the economy is a series of moving parts. And so the things that can move the easiest will get the engine started. But it will take time for it to disperse so that it can have a positive impact on the community broadly.
Well, we've got an engaged audience with us today, and they have a few questions that I want to throw out. Lynn Johnson asks, how about the new building construction and building trades? It appears that the price of lumber has skyrocketed. How long do you expect lumber's price will be elevated, and what is the basis for that increased price?
I think something, we might have a problem with Canada. When we put up barriers to trade, and I think timber between the US and the United States is one of those areas in which we put up tariffs, which cause higher prices for the importation of those products in the United States. Anybody using timber obviously is going to be affected. So that might help with the timber part of it.
Yeah, I mean that is a policy intervention that would definitely make a difference. In terms of where prices go, I think it's going to continue to be a very tight market for construction materials I would say for the rest of the year at least. It's an area where we've seen a shift in fundamental demand, and we also, because people are expecting to spend more time at home. Even if the pandemic ends, if they keep working from home, they're going to want more home space. And then we've got very low interest rates. We've got more money in consumer pockets for down payments because of stimulus checks, and because of the strength of the stock market for households who own stocks. And so all of that is fueling a really strong period of housing demand that is probably going to last. And on the supply side, I think one of the other big bottlenecks is the number of lumber mills in the United States just isn't able to keep up with the demand we have right now. And so that is a bottleneck that it's just hard to get around in the near term.
Right. So speaking of the housing inventory, it's so low right now. I mean, and houses are going like that. Do you see that continuing throughout the year?
At some point, there'll be a balance between the supply and demand side of that market. I would suggest that a lot of people would have liked to have moved perhaps last year, but they stayed in place because it was safer. And moving someplace else was not necessarily a viable option. So as the typical people who move or give up housing tend to be older folks who want to downsize once their offspring have fled the house. And so those houses typically come on market on a regular basis. But again, no one's going to move if they think that there's a health threat that's greater than their local situation.
Cliff Anthony is asking, what is the impact of the U.S. service industry due to the lockdown in Mumbai and other places in India, where many call centers and back-end operations are located?
That's one where I haven't seen any hard data. I do know that we've seen, I think over the last year, not even just the last few weeks, we have seen it be harder for those kind of service outsourcers in India to adapt to the pandemic and work from home because their workers don't have the infrastructure at home or don't have the space at home to do work from home the way workers in the United States were able to. So I think that has been a constraint on those businesses. But that's an area where I honestly I don't have too much more in detail.
I might also mention that that the health regulations may not be as stringent. And so there may be an attempt to maintain people at those call centers and those sites in ways that might be different than we might be doing here in the United States.
Thanks for that question, Cliff. Linda Kramer is asking, she's in Berea, home of BWK, and she wants to know how will the pace of economic recovery affect academia? Will enrollment decline, increase, and will new building on campus be impacted?
We had a provost meeting and a president's meeting yesterday at town hall, and our numbers are looking pretty solid. So we'll continue as usual. I think the big question was, will we have face-to-face classes as you might have had in year before this one? And that again is all a function of what's happening with regard to health. We're not going to put our students at jeopardy. We won't put the faculty at jeopardy, but in terms of enrollment, we're doing good. All we need to do is we need to pass through this. I think the bigger issue is what's happening to the demographics of youth who would go to school. And that's an entirely different question.
Right. So let me ask about where our region is compared to nationally. Northeast Ohio has for a very long time lagged the national numbers when it comes to job growth and other economic indicators. Do you see that continuing, and why do you think that is?
Well, it's 53 degrees and rainy, and it's almost May 1st. So that is a problem that I think that there's not that much that we can do about here in Ohio. I think one area where Ohio really could move the needle on becoming a more attractive place for people to come and stay is cleaning up the lakefront on Lake Erie. I think making that more of an amenity and a place where people feel comfortable using the water for recreation. I think that as a driver for hard to quantify, but it's one where I feel like the impact could be huge. I mean, think of I remember seeing a survey of millennials a couple of years ago where they surveyed them on, do you want to move somewhere? And if so, where do you want to move? And I think 1 out of 4 was Denver. Denver we don't have mountains, but we have a lake, and we could make more of it.
I think another area that you have to appeal to is the amenities available to, for example, young people coming out of school. There has to be a draw, something that says, the lake is one of those things. And I think that's important for people who might be ecologically minded. But there have to be other amenities that are attractive to young people to draw them to an area, whether these are in terms of the social environment. Is Cleveland in the forefront of any particular social issues? Is it concerned particularly with community well-being? Does it invest in people? Does it consider people as an important attribute or an asset for the community at large? And a lot of young people are very socially minded, and those bigger issues are important to them. And so to develop some kind of ecological structure, and I don't mean this in terms of environment, but an ecology around those kinds of assets would be a relatively low cost way of drawing young people into the area, or new workers who have social conscience.
Tom Breckenridge points out that there's lots of debate about the proposed infrastructure bill from the Biden administration. We're throwing around a lot of $1 trillion numbers these days. What are your views on what the bill should include and the value it could provide to Ohio and Cleveland?
Do you want to start? Do you want to start,
Sure.
Bill?
Sure, I'll start. So I think infrastructure investing. You want to invest in you want to make investments in capital that's going to generate a long-term return for the United States. And so I think in that respect, investing in the physical infrastructure of the United States, fixing our roads and bridges and making broadband more available, that will translate into higher output in the long run. I think investing in human capital in the United States through broader educational attainment and higher quality education. Human capital is actually, I think, the longest lived asset of in kind of the capital of the economy. So I think that can generate very high returns in the long run. So I think in those respects, I'm heartened that that's part of the conversation. It's obviously it's contentious and complicated politics about how do you pay for it and where does the spending go. But I think those are areas where I think the kind of high level targets seem appropriate to me, and I think will make the United States a more prosperous country in a generation.
To be perfectly honest, I'm really pleased to see the increased focus on people. I think the last time that any major fundings were available and dedicated to the development of people as talent and as an asset or a resource was coming in after World War II, when a lot of funds were made available to returning soldiers. The GI Bill, that was a huge impetus that pushed the economy forward through the 50s and 60s and 70s. I mean, the return on that was just enormous. People are important. I mean, they are the reason that an economy exists. If there were no people, there'd be no economy. So people are they're the labor, they are the consumers, and investing in them results in health and well-being for the community at large. I'm just a real positive person about investment in people over right now machinery and physical capital. The 50s and 60s, we got all of that. And almost all of the stimulus bills or tax rebates always focus on business side of the equation and very little focus on investment in people. I mean, if you invest well in youth, then that means that as they grow, they will become a major resource. They'll go on to school, they'll become entrepreneurs, they'll be able to churn the economy in ways that we may never have thought about. So I'm super favorable about it. It's people that make the economy work.
The economy is like Soylent Green.
So we've seen a lot of fiscal stimulus dollars pumped into the economy over the last year, trillions of dollars. Do you think that that was the wisest move that the government could have done?
I think it's better than leaving people living on the street.
I mean, I think it would. It would have been more efficient probably to go back 10 years and to have stronger public health infrastructure so that we didn't have a pandemic. But given the options that were available once we got into the situation that we're in, I mean, we got through it. I think the U.S. and world have been lucky in some respects that the vaccines were developed quickly and seem very effective. I think the U.S., what a lot of other developed countries did, like in Germany, they didn't need to come up with a paycheck protection program from scratch because Germany has a standing program where if a company loses revenues, they can be compensated by the government for maintaining the salary of furloughed employees. So there was no scramble to figure out paycheck protection in a lot of other advanced economies. Given kind of the tools that we had at our disposal in February and March of 2020, I think this was a way where we got through. It looks like the permanent damage to the economy in terms of permanent job losses, in terms of people who were lost their homes or had other, suffered other permanent economic losses. I think we've come out of it. I'd say we've come out of it a lot better than I feared in March of last year.
But what I hear you saying, though, is there are better ways to do this to prevent this from having to resort to those things.
There are other more efficient tools that you could use if you're willing to spend the money on them before a crisis hits. But that's kind of not our political culture in the United States. So we did what we could with what we had, and I think given the options available last year, I think that the course taken was pretty effective and made good use of what the possibilities were.
And short of us having a magic wand to change things, right?
Yeah.
Okay, we've got another audience question here. John Bechtel wants to know how you would rate the effectiveness of public-private partnerships in this region.
I'm going to apologize. It's not a topic I know very much about, so don't have too much about that.
Right. It's not on my radar that much either, but effective public-private partnerships are usually meant to be a plus for a community. So any of those that are pushing the needle are obviously doing what we need them to do. But again, it's like Bill, it's not an area of my expertise.
Let's talk a little bit about manufacturing. So productivity increased during the pandemic, but with fewer jobs. And that's a trend that we've been seeing now for decades. Is that a good sign or a bad one?
That's kind of a good for whom kind of a question. Manufacturing output, I think prior to this downturn, if I remember correctly, at the peak which was, I think, mid-2018, it was at its highest ever. While the share of manufacturing employment in the U.S. economy had fallen to, if you're looking by the industry measure, we were around 10 or 11%. And if you're looking by the occupation measure, like people who actually are in the physical work of production work, it was in the single digits. So, manufacturing becomes more automated over time. It becomes more technical work. And so it creates, higher and higher productivity jobs and fewer of them, and grows slower than the overall economy. So I think our manufacturing industry, as kind of a driver of overall growth and prosperity by, making the devices and kind of hard goods that we live with day to day cheaper and more affordable over time, I think that's going well and has continued to go well. But I think the challenge that comes out of that is if you want to have a kind of feasible jobs program to create good jobs for most of the people in your community, those jobs are going to have to be in the services sector, because that's where most jobs will be.
In talking about productivity, the fact that so much of the service sector, leisure, hospitality, and other services was sidelined, it really does place emphasis on the fact that if productivity increases occurred, they were only occurring in those industries or those areas in which people were actually working. And so it's obvious that if you subtract out all of those leisure, hospitality, and other kinds of retail sectors that we can't measure or we don't measure well, we do see some growth.
I was a little surprised. I saw for the first time this week a Viking Cruise Line ad. So they are like, we're here. We're getting that marketing play going for sure. So do you see the core inflation rate increasing this year?
So
We're
so the
thinking,
core,
sorry, go ahead.
okay, I was just gonna say, just to clarify, when we talk about the core, what we're doing is we're excluding food and fuel, which is where most people are seeing relative price hikes occurring. So everything else that's accounted for is in the core. My sense is that it's not going to increase all that much. But again, people's focus is going to be on what's happening at the grocery store and what's happening at the pump.
Yeah, definitely. On inflation, we think that core inflation is going to stay under control this year. We're forecasting to see a gradual pickup in core inflation in 2022 as the overall economy recovers more and the labor market tightens, and that fuels kind of broader based inflationary pressures. On gasoline prices, I mean, I am not at a point where I feel comfortable kind of extrapolating the recent trend with price increases. I mean, I guess they could keep on going higher, but if you think about what happened with shale oil production in the United States over the last 10 years, it's just become like the technological advances in that industry have been so fast that I think we're going to see a big jump in supply of oil, and that will kind of put a lid on prices. In the I don't have a time frame for which month it's going to happen, but I think that's something that's going to happen over the course of months, if not even weeks.
So if I can't help after asking about inflation to ask about the Fed. They cut rates to zero, of course, during the pandemic, and they're signaling that they're going to hold things for some time. Do you think they'll raise rates anytime soon?
Not soon. Go ahead, Bill, but not soon.
You've nailed it. Yeah, we have our first rate hike penciled in towards the end of 2023. I mean, there are a lot. I could talk anybody's ear off about the Fed for the rest of the day if you let me. I think one of the most striking things about the Fed right now is that Jerome Powell, who's I think he was a Republican before he took this nonpartisan job. He's turned into like a very dovish central banker, very focused on broad-based economic growth and kind of ensuring that the Fed's maximum employment mandate includes groups that have been left out of economic expansions in the past, like African Americans, like people with less education. And because of that kind of focus on how the Fed asks itself how it's doing, we're going to see a much more dovish exit from this downturn than we saw from the Great Recession of 2008-2009.
Well, the chairmanship has changed drastically at the Fed in recent. I mean, from my viewpoint, at least. I mean, do you agree with that? It's a much different role than it used to be.
Yeah, I think that the change has been away from solid financial banker banking, and no offense there, Bill. The focus on investment and whatnot. The Fed's role since the 1970s has really been what's happening to prices, aggregate price levels. And over the last little over a year, the Fed actually shifted its mandate to a pure focus on unemployment, making sure the employment numbers are up. And that's really odd, because monetary policy has always focused on, or at least for a large period of time, prices. And fiscal policy has always been the focus of unemployment. So now we have two programs, both fiscal and monetary, focused on the same long-term goal, and that is to address the unemployment issues in this country, which I think is phenomenal. And I think that bringing people like Janet Yellen in, she's a woman, so her perspective may be a little bit more different than the harder line financial that comes from a lot of male banker people. And Powell's adjustment, again, as Bill points out, I think it's extraordinary. I think it's right
again, I just love talking about the Fed. Another point that I think is really important to be thinking about in terms of where U.S. monetary policy is going to be over the next 10 years is that we've seen this long-term decline in inflation around the world that has been pretty closely tied to when societies age, when you see a peak in the working age population, and when you see kind of a wave of retirees taking up a bigger and bigger slice of the population. So, that hit Japan and inflation plummeted. Now Japan struggled for decades to get out of deflation. And now they've had, quantitative easing and negative interest rates for decades. Just now they've managed to get inflation just barely above zero. In the Euro area, they've had negative interest rates for 6 years. And inflation kind of dropped below the central bank's target, I think in 2013. I don't like the head of their central bank said last Thursday, she just really can't foresee circumstances that would justify them getting starting to raise their interest rates. So I think, I get a lot of client questions, and I get a lot of questions from journalists as well about inflation, and do we see risks that inflation gets out of control? And I'll say, I think about inflation a lot, but I worry about deflation or disinflation, and I worry about the Fed kind of getting backed into having rates be at zero forever or negative interest rates in the United States. This Fed, they say that they don't want negative rates, but no central banker wants to impose negative rates. It's a really unpopular decision. It's something that they kind of get forced into. So I think to the extent that the Fed runs the economy hot, and keeps upward cyclical pressure on inflation to kind of offset those longer term demographic pressures, I think I think that's probably the right course.
All right, so 2 final questions. Of course, I cannot ignore the fact that the NFL draft is in Cleveland today on this beautiful day. So you always hear the direct spending numbers that get thrown around anytime an event like this is in town, and millions of dollars are going to be generated from the RNC, and then they come out with a study after to show what was actually spent. What are your thoughts on those direct spending numbers?
It's a question, Bill.
Like it's good for the local economy to have people spending money locally. So I think that's great news. It's very good news for the retail sector, for restaurants and small businesses. And I don't want to downplay any of that, but I will just kind of say, so I started in PNC as the international economist and kind of shifted more into doing US domestic stuff over the years. But on international, I've covered, like I remember Brazil entered just a horrific economic downturn just as they were hosting the World Cup. And these kind of gigantic sports events, not obviously the same as what Cleveland's doing this weekend, but those kind of gigantic sports events do not tend to generate return on investment the way you could get from other public investments that are a lot less interesting and less fun.
People are fun.
All right, final question. So as we sit here today, how optimistic are you for recovery for Northeast Ohio and nationally?
I'm optimistic. Go ahead, Bill.
I'd say 8 out of 10 optimistic. I think it's
wow, that's a great number.
There's still a lot of ways that things could go wrong, but I think we have a much clearer path to an economic recovery, and we still have a ton of tailwinds from fiscal policy, a ton of tailwinds from monetary policy. If the management of the recovery screws up this time, the least that we can say is that they will have screwed up in a different way from last time.
I look at this period as being what you might consider the Great Reset. Okay, so we're going through this process. We've experienced this pandemic and we know what the real numbers are. They're not debatable. We know what the real casualties were. We know what the real implications are of this pandemic, and having that not be politicized, okay, says that in this period of time, we can make choices that are different than the choices that we made in the past. We can start engineering socially so that the community at large can be better off. And I think this is something that can move all of us forward, and we can do so collectively as a body, and to really be proud about who we are here in Northeast Ohio.
Well, those are great notes to end on. I want to thank Dr. Kay Strong and Bill Adams for joining us today. This has been a very informative and lively conversation. This is lots of good thoughts, and I love the fact that we ended on an optimistic note. I want to thank our audience for joining us. Please consider joining the Press Club of Cleveland. If you're not already a member, you can visit the Press Club website to get more information on that. And again, thank you everyone for being here. Thank you for your time, and enjoy the rest of your day. Take care.
Thank you,
Thanks.
Elizabeth.